All right, the market got what it wanted, and what I think that we've always wanted this whole time, and all of last year and into this year. We want rate cuts to be on the table, but we don't want to have to use them, and that's exactly what we got today. We got updated economic projections that pretty much showed we don't have to use the rate cuts, but we got a lot of chatter about the fact that they're still on the table, and so that, if they come off the table, that's when the markets respond pretty negatively, as we saw last summer, last July, August, September. But since Halloween, when they've been back on the table, and especially this year when we've been kind of pushing them further away without having to use them, the markets really, really like that, and that's what we got a continuation of today. And we'll take a look at the technical bounces that we've seen. A lot of really good technical signs on today's bounce. We'll take a look at that. What we expect to see going forward. We'll take a look at some of the other relationships, these different assets, especially the important ones that have been driving risk appetite here lately in our sector rotation. It appears to be we might be getting a new leg in sector rotation. We'll break that down. And then our trade ideas, the stock is very similar to market, had been in a convergence, more of a consolidation than even what the market saw, and had a nice little breakout move today to the upside. And so we'll trade it with that same idea of how much longer will it have to go up, and we'll break that down and break down the breakout signals that it got, again, similar to what we're seeing on the broader market as a whole. So let's go ahead and get started. Today is Wednesday, March the 20th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out some of these other things over here on the right, including our Market Outlook Live video where I review all the old trades. We closed one out today from an old video. We put on today's trade today. We looked at today's trade today before the market closed. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click this thumbs up icon. It opens up this tab. Hit that like button there. Again, the more you do that, it helps get our content out to all of our followers. We hit 70. That's a milestone. It's been a while since we've been out of the 60s. So thank you to those who like these day in and day out. Those who don't, you can do it right now while you're watching. We see if we can get up to 100 this time. All right, let's start off taking a look at the market forecast on the S&P 500, just like we always do. As you can see, we continued higher today, back above the 2.5% mark, up above the 30-day moving average. So we kind of got back into trending mode there. After some sideways action that converged us down, we ultimately got down to just 1% above. Which doesn't sound like that big of a deal, but that was the lowest point for weeks. That was the closest point to the moving average that we've been in weeks. But back up above the 2.5% mark, a near-term line getting up to an extreme level, which is very good. So in fact, I think that might be the highest level that we've seen. If we got up to 95 there, over here we got up to 98. So it's the highest level that we've seen on the near-term line since last December, mid-December. So it's been, 3 months that we've been. The momentum line's up to, not into the reversal zone, but it's up. And of course, your intermediate line's rising, almost back above the 90th percentile again. Has been above the 80th percentile for a very, very long time. So has the market sentiment line, which is also now rising, and your intermediate line is back up above your market sentiment. So the S&P has been the strongest index. Let's look at some of the other ones that have been a little bit weaker. So we did get a bull tag on the NASDAQ, so we actually did dip our toe below. Remember, the lowest that the S&P got to was 1% above. We actually got below it by 0.5%. But we have now bounced back up. We're back to dark green shading, the green line. The near-term line has crossed through the intermediate line, and it's now in the reversal zone with the momentum line. Very good cross, looking like we have an opportunity to start a new leg higher here. Whether it lasts this long or not remains to be seen, but at least we have an opportunity to start again, similar to what we saw over here when we came off that bull tag, and you had a good strong cross of the near-term line above the intermediate line, and then we brought the intermediate line back into the reversal zone. So that's a good sign for the NASDAQ 100. The Dow Jones has also been relatively weaker, also produced multiple bull tags. But the same thing happened again. We are strongly crossing above the intermediate line with the near-term line. It is still below its market sentiment, so a little weak there still, but the cross over the near-term line well into the reversal zone suggests that we're going to make our way back up here to the with a new leg higher on the Dow Jones. So that looks really good. And then your Russell 2000, you can see same thing. The near-term line intermediate line had crossed below its market sentiment as well, but at a lot lower level. But the near-term line bounced up today, so we got a bounce right off of this bull tag. Clear bounce up, pretty strong move, almost 2% up to the upside. Very, very good, almost 2% above the moving average. And the cross again of the near-term line above the intermediate line. Those are all very, very good bounce patterns that would suggest that there is more upside to come. That we're bouncing off these bull tags instead of starting new intermediate declines because we haven't bounced. We have now bounced, and they would suggest new legs to the upside for however long they last, right? The S&P's intermediate runs already, 4 months in, almost 5 months long. So it's already a mature run. So we don't know, we just don't know how long the leg's going to last. But of course, we'll ride it as long as we can get it. That's also produced another bullish weekly candle. So we were starting to get some weakness here. We had a lower close, slight lower close from 51.25.19 to 51.25.01. So it's about a slight of a lower close that you can possibly get. We did get a lower high too. So, it suggested that we could go into transition mode, and we have broken through that. So we're closing now. We're not above this high point yet. We're closing at 51.84. That high was 51.89, but you're almost above those highs. And when you get a close above prior highs, that starts a new leg higher. When we've been in convergence mode, you can see we crossed back above the size of the candle, crossed back above its moving average. Of course, we are in the upper decile for how far away these two lines are from each other, up almost 8%, which is a very high mark, about as high as what we got in 2021. Not the highest of the last 5 years because of the COVID move, but we're still in the 91st percentile. There's your COVID move again. If you follow my cursor, it's a pretty high level. That the gap between those two lines are a pretty strong move higher here as we are just now in kind of grinding mode. And again, we've been bullish here. In fact, if you look at the whole moving average and do it on a weekly basis, you can see the reversal pattern here, flipping the parabolic star down, flipping the whole back up to green and still above the 200 and getting back above the moving average of the PPO with a strong candle down here. So a good reversal, but if you notice a weekly, we never did reverse down to the downside, even with last week's weakness. And we're still, multiple weeks of positive candles here. Only one small, very, very small bearish candle there for a transition that never turned into a transition. We just got right back up. So very positive candles. And again, in the about as high above the 200-day haul as you'll see, right? A 200-week haul, excuse me. It's the highest that we've seen, going all the way back here to, and when we broke through the negative, finally in 2009, and at the beginning of 2010, we were really strongly bullish above that 200-day haul because we went up so strong at the end of that year. It's the kind of move you like to see when you're coming off of a bear market low point. So we're having a similar move now, obviously not off of a bear market low point, but pretty strong nonetheless, about as high above that 200-week haul as you'll see. Remember, the haul is more of a like an exponential type. It doesn't have nearly as much lag. In fact, the moving average has the least amount of lag on it. So it's really hard to pull away from these long-term hauls because they move up so fast, faster than a 200-day simple moving average, far faster than a 200-day simple moving average. So to get this far up above it this fast is pretty big deal there. Let's take a look at the 3 green arrow chart, and you'll notice, again, we don't have 3 green arrows yet, but that's how close we are. The MACD is just barely negative, so we're almost at 3 green arrows again. We did get 3 green arrows on the diamonds because its MACD did jump up above, and you're almost there on the IWM. You still got 2 reds and then the 1 red on the Q. So you're almost back to 3 greens across the board, probably another day or 2 away from that Obviously, you're going to be back above moving averages here, easily above the 8-day. Remember, that was the strongest one. The Qs got back above its 8-day, so that's a big deal. MACD and Stochastics almost back above their moving averages. And then IWM also cleared back above its 8-day. Again, it had been below its 17, and MACD and Stochastic are rolling up and closer crossing above. So just a great day, a lot of volume, of course. Great day. Let's follow through on this day to the upside. So instead of just being a one-day thing, but considering how big of a move it's been today, like I said, almost 2% on IWM. Again, you look at the daily price moves here. On the S&P, it wasn't that big of an up day compared to recent, but for IWM, that's a pretty decent move to the upside. So very, very good chance that we can be able to follow through on that. Historical volatility had really come down in IWM to a significantly low level. And we'll see if now we can get a rally, we can get a move up on this from these extreme lows with a rally. Usually when you get to these extreme lows, it starts a period of weakness. As you can see, lots of red bars, and this usually rises. Historical volatility rises from extreme lows with those red bars. We got a jump up here with some big green bars that jumped it up, and then you can see we really tapered off really fast until today's move, and we'll see if this starts more of a move like this, or if it's a one-day up move that then leads, that starts a period of volatility of bigger moves, but bigger down moves to go with that up move. I tend to lean more towards that will hold this move and this, just like we did here, and just start going right back down to really, really small ranges on this. Speaking of the range, obviously today's move was a sizable range above the average, well above the average there, 5.5 points. And then the volume was at 69 million, so it was also above its average. When you look at its numbers down here, 5.5 points is above the ATR, so that brings us to 95%. But now, see, if we're going to be bullish, we can't have more days like this. This is a one-day thing. We need to hold this gain, right? We can't have a big down day now, because if it sparks a series of bigger moves, it will include down days. It's not going to spark a series of big up moves, right? And clearing this one, if we clear this 1% mark, it's going to be a bearish move, not a bullish move. Typically, of course, anything can happen as we've seen, but typically it's bearish moves that clears this, and you can see the volume, it has been rising. So we need to get back to just boring days again. One day is great. Let's get back and let's hold it with some boring, small range, small volume days to the upside that continue to grind us up. You can see the volatility index fell way down to almost 13. We fell to its lowest level, to this 85% mark, for the first time in a few weeks. Right? It's been multiple weeks since we've gotten down here. Last time we did get down, we were a little bit lower and we jumped up. That was back here in early February. If you look at, back over here, that early February was right in this level. The VVIX had jumped up along with it. Your VVIX dropped all the way. I mean, we had been up above 92 right before options expiration. We were already back down below 80. Remember, 80 is an extreme. So just like that, the VVIX and the VIX both have dropped back down below 80%, and the VIX itself has dropped back below let's go to these lines, to the various average values of the VIX, and you can see we had dropped to the 50-day yesterday. We dropped significantly below. In fact, you could argue this is one of the bigger drops below the 50 that we've seen in a while, because we've been kind of holding the 50 for support. So yeah, you can see right here during this entire run, we were below the 50 pretty significantly until we got above it, and then this is right now our biggest move below it during this entire time. Now these last two times we got below it, we jumped up, and those last two times, again, early February and then early March. When you look at those over here, early February, as I told you, we were at the 85% mark, and then early March here we got below the 90% mark. But over here you can see the VVIX in early February had gotten down well below 80. In early March it also got below 80, and now here we are below 80 again. So are we going to do the same thing we did, or are we going to make more of a concerted run down to, towards 80%, which is what happened at the end of last year, middle of December, when right before we started this upward move higher in volatility. This kind of slow move higher. We've been able to withstand the seasonality of the VIX, right? Just like we've been able to with the stock market as well, right? This has generally been a period of volatility, and now we've ended that, right? That ended a week ago, tomorrow, and so now this is a period of decline. Now, granted, we've declined almost already that much in just like a day, but now we, through the end of April, we tend to have a period of decline in volatility. Now the question will be, because of how low we already are, at 13 and at 85% and well below its average values, how much more downside does it have? You can see it's back to a strong, after a brief positive correlation with the markets, which, again, doesn't really last for very long when you get these brief positive levels. It tends to be positive on these big bullish moves here on volatility. But now, now that we're back to markets going higher with volatility going lower, it's back to a very strong negative correlation there, which is what you expect to see. All right, now let's take a look at what's driving the price action. And we obviously know what happened today. The post FOMC, we can see how the markets responded. Small cap stocks really took off again, nearly up 2%. The S&P, the Qs were up, the purple lines, the Qs. Developed markets and emerging markets both rallied as well pretty strongly. The dollar fell after the meeting, rallied initially with stocks, but then and yields really took off initially. But after the press conference, yield actually lost their gains, and the dollar really dropped pretty significantly. Commodities started the day down. They have been so bullish. They actually rallied a little bit post FOMC. So those three things continue to be the main drivers. Look at this pattern on the dollar. So after getting up to the 200-day moving average, pretty big reversal pattern here. Pretty big drop down to the downside. In fact, when you look at the market forecast, the near-term lines cross back down below the intermediate line. Intermediate line still below market sentiment. Extreme low on the momentum line. So there's a good chance that we are bearish for a while. You got that bear tag yesterday, but instead of going through, we've come back down to the downside. So there's a chance we might get a little bit of a run to the downside in the dollar. That's really bullish for equities when the dollar makes a run to the downside. The 10-year yield also had been rising, right? But it has the last couple of days dropped. Its near-term lines down. We got an intermediate confirmation signal yesterday. The momentum line bounced back up out of it. The near-term line dropped in the bearish territory. Now it's a question of how bearish will that near-term line get? Are we going to drop or bounce, right? So we're still, intermediate line still above the 80th percentile. We did get a bearish crossover, but it's okay when the intermediate line's in the upper reversal zone and still above its rising market sentiment. So we're still set up to bounce here on yields. And that's really could be the one wild card that could limit the upside of this bounce that we've got in the markets. If yields bounce back up above 4.4%, but you would expect that they would do, that's the expectation, then that could really limit, right? That you'd have to have a significant drop on the dollar to help offset that. And remember, the other thing, and what's really keeping yields from dropping, is the commodity prices. You can see commodities, as I mentioned, started the day down pretty significantly, but rallied. You're still you still got a very strong trend. You're getting a near-term decline, but nothing really more than that, right? And remember, the biggest component is energy prices. And yeah, you had a down day today in energy, but again, you've got the near-term line down to bearish territory. Now you expect will bounce. So if we bounce and yields bounce, and the dollar's just a one-day drop, and it gets back above moving averages, then today's bounce in the equities might be very short-lived. So, that's something we have to really pay close attention to. We would like to see more of a near-term decline in yields, more of a near-term decline in crude and commodities, and a continuation of this bearish move in the dollar. Those three things would help fuel risk appetite to the upside. When you're looking at the breadth by the end of the day today, it wasn't so good at the beginning of the day, but things change, right? Let's take a look at the breadth. Sorry, wrong chart. McClellan oscillator. You got up to plus 27. Remember, this is advancers relative to total issues in the New York Stock Exchange. And so you got up to a 27 here. This also measures the gap between the 19 and 39 day exponential moving averages of the McClellan indicator. And then you also have the summation index, which is still very, very high levels. You can kind of see going back. It didn't stay above 500 very long there. But once you get bullish, it can stay above 500 for a while, and you can really establish some good trends. And that appears to be the case right now, because you can see once you started here, then you just kind of maintained it with some weak breadth, right? You have good breadth at the beginning, and then weak breadth after. And now again, you have very good breadth here at the beginning, and then we had substandard breadth afterwards. We never really got above 35 again as we kind of converged, and we finally got some volatility here. And you can see the same thing if I were to go back a little bit further to some other bullish trends like we're seeing right now. You got very strong breadth coming off 2019, then you had very weak breadth, and the next leg higher led to a pullback, and you had pretty decent breadth going in to this first move here, and then you had pretty decent breadth until you really tapered off into COVID, and then you can see the same thing happened. You had a very weak breadth here going into that peak. That tends to happen, right? When you've been above 500 for a while, you start to taper off on the breadth, and like you can see a pretty significant divergence showing up here, kind of like what we saw here going into the COVID move, and some other divergences you see as well. This one over here leading into this period of intermediate decline in 2019. So, and a big one here on this divergence that led to the first quarter weakness in 2018. So a pretty significant divergence now, because again, the second leg has a lot less breadth than the first leg did, when it was a lot of advancers relative to decliners. If you look at the one good thing about the breadth is the number of stocks above their 50-day moving average really took off today. Very, very good sign. Almost up to 400 again, which would be the 80% mark. So very, very good sign. The 200 number of stocks above the 200 did jump back above 400, both above their rising moving averages, so a little bit of a divergence down there. And the number of stocks above the 50, you can see up 5%. And if you look at that ratio, then the ratio chart is right at 1. So we're really, really close to getting that ratio back down below 1. Remember, we're already below the moving average, which is bullish. Getting back below 1 would be really bullish, right? Those are the things that really kind of take off on this chart when you're on a bullish trend. You want to get down below 1 and stay below 1 for a good long period of time. If I were to go out to kind of show the longer term trends like this in 2021, you can see we started to have, we had to bounce off of these lows to get going up to the upside, similar to this, bounce off the lows. But then to get going, you can kind of see how we started to ramp up. But every other instance here, where it goes down when the markets go down. And so we're kind of in that mode here. We've had a little bit of a rally up to the upside as it dropped. And then as we dropped here, as we had a pullback, it ramped up to the upside. And you see that quite a bit. You see the ramps on the pullbacks here. You had these ramps up to the upside. What we want to see is, we don't want to see a correction move where they both start falling down. And that's kind of what you saw in this instance here, and all these other moves, to where we get to the low points. Typically, these significant lows in the ratio coincide or come right after the lows in the index itself, right? When we get down to these very, very low levels. So we're on a low decline now. We kind of need to see, like, if we break this 1, we have a chance to be pretty bullish here, but we can also start a correction, right? It can end up starting a correction here. So we'll see how that ends up playing out. But again, these are good signs. And then you also see the new highs and lows index jumped up to 400. Again, this has to be updated with both the New York Stock Exchange and the NASDAQ Composite. That usually happens a little bit later in the evening. So it might not be as strong, but still the fact that we're around that 300 level where the moving average is, after being slightly negative just about a week or so ago. It's a really, really good sign that we've gotten back up. The other thing too is the dark pool buying and the gamma exposure, which represents retail buyers. We're still, remember, the gamma exposure tends to peak, bottom out at the lows and peak at the highs. Well, we kind of did here, but then we, instead of consolidating, we jumped back up. But we didn't jump back up to new highs with new levels of gamma exposure until today. This is the highest level gamma exposure, so you had a lot of retail buying today. The biggest levels we had pretty much since over there, and you can see about as high as we got at that peak over here, and about as higher than we got at this peak over here. Goes out to 2 years. Let's see if I go out the maximum. Here's where we are right now, and you can see it's one of the higher levels since the correction started. We had a lot of gamma exposure during the Robinhood days, but if you go back before that, it's pretty high level compared to some of these other peaks that we saw before the Robinhood everybody's a call buyer days of COVID and risk, the risk on days of ARK investments and everything doing so well. So that's the gamma exposure. If I go back to the dollar, to the dark pool buying, you can see again, let's go 2 years. So we can see this move. So here's the low point, and we had a low in dark pool buying at the low point, and then we started to rally, right? And you can kind of see you have a low at the lows, and then you kind of rally, and then it tapers off as you go into a peak. Well, we've been tapering off in a big way, and we're still tapering off. Even today's peak is still much lower. So we hit a low point at the lows. We had a good surge of dark pool buying during this first leg higher, and then now have been tapering off as we've been going into this last leg higher. Here the question will be, you can see there's a lot more buying on these runs over here than there's been on this one. So it's a little concerning from that perspective, because this isn't your retail investors. It shouldn't be tapering off, especially this much on this bullish of a move, including even today when the gamma exposure itself had jumped up so much. So a big divergence here between dark pool and gamma exposure. That divergence typically resolves itself in favor of whatever's, in this case, whatever's the lowest, and that happens to be the dark pool buying in the down here. Let's take a look at the sector rotation today. And obviously we had our risk on move, so we'll just go to a comparison chart, and we'll go to just today alone. We've been talking about a rotation into safety here lately, but communication services had been moving higher, but now you've got all three: communication services, technology, discretionary up here with materials, financials, and industrials. That's pretty much all the cyclical areas except for maybe energy, but energy's been behaving more like a safety trade here lately. So that is a full-on risk appetite mode. When you look at the relative rotation graph, you can see how communication services has already been improving in the improving category. Technology had been in the improving category and is working its way down. Discretionary is gaining some momentum, but it's still pretty low, and it's still pretty low on the relative strength as well. So there's still some work to do for those three areas to get into the leading category, where you still have staples, utilities, energy are still your leading areas in the market. Those are your safety areas in the market. And we'll see if we get one more round of rotation into these cyclical areas first before we get more of a longer term. You can see on a long-term basis, remember, those areas are still in here. You can still, industrials and financials are, industrials is almost into the green, financials is barely into the yellow, technology and communication services are over here as well, and your safety areas are still pretty bearish down here. So there's still a lot of relative strength on a long-term basis in these cyclical areas. There's energy there, having broken through its 50-day moving average down there. Technology, despite its rally today back above the 8-day, is still below its 50-day average and still in the wrong quadrant with both lines below 100. So we need more than just one day. We need to bust through these highs and trend up here for a while. Otherwise, this will just be a one-day phenomenon, very short-term phenomenon, and we'll see if we don't even by the end of, like, say, next week. If by the end of next week we reverse today's move, then that's going to be pretty bearish. But if by say the beginning of next week we get through these highs, if we really follow through with this and get through these highs and get going, and this gets back above its 50-day, great, right? That's, we got at least one more leg of cyclical areas leading the way higher. So we want to see the Qs continue to outperform, right? We want to see the Qs. It dropped today. It dropped just a little bit by the close, but we want to see this outperform to the upside. You can see the MACD is rising, so there's some opportunity here, but we want to see this outperform to the upside if we're going to maintain bullishness. Otherwise, we especially if we break the 200-day moving average, that's the last thing we want to see. Here at SPY, another look at this with just looking at the S&P 500 stocks. And you can see we did jump today, barely, but we did jump. Well, at least we did a pretty good jump, but barely above yesterday's open, back above the 30-day. We can't stop here. We need to break through here, just like on the Qs and IWM, with it correlated to the markets, and continue higher. So let's see what happens after a nice one-day bounce trade here in equities. So our trade idea kind of matches what the market's doing. It's had a little bit more of a pullback than what the market says. DraftKings. Let's look at this market forecast chart first, and then we'll look, especially going into the market tournament here. But we had bull tags in DraftKings. We had a pretty good consolidation. The intermediate line got to the chart's midpoint. It didn't quite get the bearish territory, but it got to the chart's midpoint. But then big break, and the market sentiment line's rising. Intermediate line back into bullish territory. Short-term sentiment crossing through the intermediate line, and you're not very far away from the intermediate line crossing the market sentiment line. So good breakthrough here on DraftKings up to the upside. Very strong break up above recent highs on the stock itself. You can see the weekly chart looks after having some transition candles that never turn into consolidation. We bounce back up with a pretty good bullish candle here this week. Obviously, you have 3 green arrows and a pretty decent amount of volume today. There's your 3 green arrows. We actually got it yesterday, but bigger volume today than what we saw yesterday. Well above moving averages. You can see we're also above the top of the value area, clearing the one volume node you had above the value area, the MACD and stochastics, above their moving averages and starting to move back up to higher levels. You look at the DMI, some of these other oscillators. Bullish breakout pattern here on the DMI above 30, well below 20 on the negative indicator. The RSI and the CCI, if you take a look at that, you can see we're back above 60, well above 100, up to above 200 on the CCI. So a good move there. The Ichimoku cloud, we are establishing a new trend that's weak and not very far away from being intermediate trend strength already. Positive rate of change above the cloud. And then the Bollinger Bands and the Keltner channels, you can see we broke above the upper band today. After the bandwidth really got down to 150-day lows, we broke up above the upper band, up above the upper Keltner channel, and away we go. Positive momentum, and the bands are just maybe a day or two away from breaking out the Keltner channels themselves. So what we decided to do was to sell the mid-30s delta, the 49, buy the 47. Gives us about depending upon where we get filled in, about a $500 risk with about almost a 2-to-1 reward to risk ratio if it ends up working out in our favor. And see, the trade didn't go through during the Market Outlook Live, and we'll see if it ends up going through tomorrow morning. All right, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.